In the last chapter, you learned that corporate capital is broken down by the source of capital. In that chapter, we looked at paid-in capital, which is the capital paid in by the owners or stockholders through the purchase of stock. Remember, the par value was credited to common or preferred stock, and anything in excess of the par value went into the additional paid-in capital. Currently in this chapter, we will be studying the second source of a corporation's capital, which is the corporation's earnings. The earnings are kept in an account called retained earnings. The balance in retained earnings comes from what the company earns by conducting business. If you remember, at the end of the year, with a sole proprietorship, a company's net income is closed to capital. It's the same with a corporation. The net income is closed to the retained earnings portion of the corporation's capital. This net income is the only credit to retained earnings. It's the only way it can be increased. So when it's time to close the books, remember, the third closing entry is where we close income summary, which contains the net income or loss, and we close that to the capital, or in a corporation we close it to retained earnings. So if we have a net income, we credit the net income amount to retained earnings. If we have a net loss, which is the case sometimes, we will debit retained earnings, and it decreases our retained earnings. Dividends, which we are about to look at, are also debited to retained earnings. They're like a company's drawing. So drawing, if you remember, decreased capital, so dividends decreases retained earnings. And then we have appropriations. These are just setting aside a portion of the retained earning balance, and we'll look at those in a few slides. Okay, so let's look at one type of dividend. It's called the cash dividend. Dividends come in many forms, but we'll look at the cash first. Dividends are earnings paid out to the stockholders or the owners, and a cash dividend is paid out in the form of cash. To be issued, a dividend has to have 3 conditions. There has to be enough retained earnings in the company. The company has to have enough cash, of course, before you can declare a cash dividend. And then the dividend has to be declared by the board of directors. So before a dividend is given out, the board of directors sits down and looks at the retained earnings account and makes sure there's enough retained earnings. Then they'll check out the cash, and then if there's enough, they will declare the dividend. There are 3 important dates related to dividends. The first one is the date of declaration, because on the date that the board of directors declares the dividend, the company becomes liable for that dividend to the stockholders. So a journal entry has to be made for the liability. Then there's the date of record. This requires no journal entry. It just indicates which shareholders will be getting the dividend. So whoever owns the stock on the date of record will be the stockholders who are entitled to the dividend. And then, of course, the date of payment. That's the date that the dividend is paid, and it does require a journal entry. So let's look at an example. On February 1st, the board of directors declares a dividend of $2 per share on 10,000 shares of common stock. The dividends are payable on February 20th to stockholders of record on February 10th. Okay, so there are 2 journal entries that we know we will be responsible for, and the first one is on February 1st, the date of declaration. A $2 dividend was declared on 10,000 shares, so the corporation is liable for $20,000 in dividends. So that journal entry is debit cash dividends for $20,000 and credit a liability called dividends payable. On the date of record, which is February 10th, no journal entry is required. And then on February 20th is the date of payment. So we're in effect just making a payment on account. So we're going to credit cash because we're paying out the dividend, and then we debit the liability dividends payable. The second type of dividend is called a stock dividend. The stock dividend is just a proportionate share of shares of a corporation's own stock that's paid to the stockholders. So let's just look at an example. Sometimes a corporation may not have enough cash, yet they want to give the stockholders a dividend. And one way that they can do that is with a stock dividend. And stock dividends are pretty common. So Davis Company has 4,000 shares of $5 par common stock outstanding. They declare a 10% stock dividend on March 5th, payable on March 27th to stockholders of record on March 14th. The market value of Davis's common stock on the date of declaration is $12 a share. So the first and most important thing we need to figure out is how many shares Davis is going to issue. If they already have 4,000 shares and they're giving out a 10% stock dividend, 4,000 times 10 means they're giving out 400 shares of stock. Then it's important to know the market value of those 400 shares. So 400 shares at $12 a share is $4,800. And then of course you know when you're giving out stock, the par value is extremely important. 400 shares at $5 par is $2,000. So now it's time to journalize the declaration of the dividend, because the corporation is liable on the date of declaration. So instead of debiting cash dividends, we're going to debit stock dividends in this case for the market value. Then we're going to credit stock dividend distributable. This is kind of like our liability account. We pay cash dividends, but we distribute stock. So the wording is stock dividend distributable, and that's at par value. So 400 shares at $5 par. And then the difference, of course, that you learned in chapter 19 is the difference between the two goes into the paid-in capital in excess of par. So it's very similar to actually giving out a dividend. So of course there's no entry on the date of record, and then on the date of issue we're going to actually give out the stock. So we're going to debit stock dividend distributable at par, and then we're going to issue the stock at par. Next we'll look at stock splits. Stock splits are when a corporation exchanges one share of an old issue of stock for multiple shares of the same stock with a reduced par value. For example, Link Corp has 10,000 shares of $10 par common stock outstanding. Link declares a 2-for-1 stock split. What that means is that each shareholder is going to get 2 shares of stock for every 1 share that they owned previously. Now the par value will be split in half while the number of shares are doubled. So for example, if we had 10,000 shares outstanding, there will now be 20,000 shares outstanding. The par value will no longer be $10, it will be $5. So with the stock split, the value of the stock on the books actually doesn't change. Previously, there were 10,000 shares at $10 a share, which gives us a $100,000 value. After the stock split, we'll have 20,000 shares with a $5 par value, and that's still $100,000. So the value of the stock on the books does not change after a stock split. Therefore, we don't need to enter a journal entry. Instead, we enter a memorandum entry in the journal. And in the journal, we just write, declared a 2-for-1 stock split resulting in 20,000 shares of common stock with a $5 par value. Next, we will review the retained earnings statement. The retained earnings statement shows the changes to retained earnings over the course of the year. Notice that the regular retained earnings account is shown first, followed by the appropriated retained earnings accounts. The beginning balances are shown first, followed by the changes in each account. Notice that the only addition to retained earnings is what we talked about earlier, net income. It's the only way we can increase retained earnings. And then that's followed by any appropriations that occurred. We had the appropriation for plant expansion transferred back into the regular retained earnings. So we closed out that appropriation. And then we had another appropriation for bond indebtedness. So you will see the 1,000 moving out of retained earnings into the appropriated retained earnings account. And then last, we show the dividends that were paid. So we had a decrease in retained earnings for the dividends, both stock and cash, that were paid out of the account. And then followed by the ending balances in each one of the retained earnings accounts.